things are not looking good. Warren Buffett is ringing the alarm bells because he's worried that America is heading towards a huge crisis. This could be even bigger than the Great 1929 crash or the recession of 2008. It has recently been revealed to the public that the United States has taken on a mind-boggling debt of $1.4 trillion in just the first 9 months of the 2023 fiscal year, with $228 billion of that borrowed in June alone. These numbers are scary, and if we don't navigate this time carefully, everything could collapse. Now, all eyes and ears are pointed towards Warren Buffett as we eagerly wait for his advice. So let's listen to what our favorite investor has to say about the current economic crisis.
But it all has consequences, and well, we are starting to see the consequences of people who could borrow at 2.5% and find out it doesn't work at current rates, and they hand it back to somebody that gave them all the money they needed to build it.
Everyone's throwing around the term real estate bubble, but how many people actually understand what this means?
In my view, you're likely to see the greatest fall off, and where you've had the biggest bubble are the ones tend to be the high-end market, and they tend to be ones where people have bought for investment or speculation rather than use.
Simply put, a real estate bubble forms when house prices go up, not because they are actually more valuable, but because of more superficial factors, such as market hype and excessive borrowing. Over the past 15 years, the US has seen this exact scenario play out many times. With interest rates at historically low levels, it's become really cheap for people and businesses to borrow money. And what happens when regular people are able to access cheap loans and have a desire to build wealth? They buy investment real estate. And with so much demand for real estate, property prices get driven up as people compete against each other. This quickly drives prices to ridiculous levels that don't match the true value of those properties. Let me show you a practical example of this in action. But first, I wanted to tell you guys about a business model that I recently discovered. It's been around for a long time, but it seems like people who are making money from it love to keep it a secret. So I decided to leak this to all of you as a thank you for watching this video. So if you want to earn an extra $2,000 to $3,000 per month on the side, click the link in the description to get started. Now back to the video. Consider a young couple looking to buy a house that costs $400,000. Because interest rates are low, they can easily get a mortgage and also secure very affordable monthly payments. The low monthly payments are a direct result of the low interest rates. These low rates make it much easier for people to buy homes that they would otherwise not be able to afford, and this ultimately increases demand for homes and drives prices up. Now just rinse and repeat this same scenario millions of times throughout the entire country, and you can see how a housing bubble forms. But the real problem can be seen once the interest rates start to rise. If the couple's mortgage has a variable interest rate, their monthly payments go up as interest rates go up. So if all of a sudden interest rates go up, but their annual income doesn't grow at the same rate, they could struggle to make the monthly payments. And if they default a few times on their mortgage, they might lose their home to the bank. The commercial real estate market is affected in a similar way. A business owner might buy a property for a business when interest rates are low, but if those rates climb, their loan repayments increase. When this is combined with economic challenges like a downturn or less demand for physical storage space, they might not be able to keep up with payments. As more and more people and businesses are unable to buy their mortgages or loans, the market could see a rapid increase in foreclosures. This floods the market with new properties available for purchase, causing prices to drop sharply. Suddenly, properties are worth less than what people paid for them, leading to lost equity and financial distress. In this way, the bubble, created by a combination of low interest rates, high borrowing, and inflated property values, is at serious risk of bursting.
Most people like to buy with non-recourse in real estate, and one time I asked Charlie, there was some real estate guy we were talking to, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name.
To understand the clip you just watched, you need to know what non-recourse debt is, especially when dealing in real estate, particularly in large transactions like purchasing office buildings or malls. Basically, it means that if you borrow money to buy a building and things don't go well, you can give the building back to the bank and walk away without owing more money. Non-recourse debt is similar to leasing a car. If you lease a car and can't make the payments, the leasing company can repossess the car, but they can't demand additional money from you or go after your other possessions. The car serves as the main collateral in the agreement. Keep in mind, while this kind of deal may seem advantageous for the person borrowing the money, it poses greater risk for the bank. Buffett highlighted how this practice is quite common in real estate, when people borrow substantial amounts because interest rates are low, anticipating they won't have to pay much. However, if those rates rise or if the building's value decreases, they can simply hand the keys back to the bank. In such a situation, the bank has limited recourse, and its only option is to foreclose on the house. Additionally, the law prohibits the bank from taking further action to collect the remaining payments. Buffett emphasized that when a significant number of people engage in the practice, it disrupts the entire market. If everyone starts returning buildings to the banks, there will be an oversupply of buildings for sale, causing prices to drop. Imagine if everyone in your town tries to sell their cars simultaneously. The price of cars would decrease. So while non-recourse loans may seem appealing as they are less risky for buyers, they can have detrimental effects on the economy in the long run, which is what we are seeing in the market right now. The consequences of doing this over and over are severe enough to potentially trigger an economic crisis. Warren Buffett's advice to investors, be fearful when others are greedy and greedy when others are fearful, perfectly captures the ripple effect on businesses, especially in the real estate market. This advice is particularly relevant for small regional banks that eagerly enter real estate lending when it appears to be easy money. During prosperous times, these banks generously lend to local businesses and homeowners. However, when the real estate market faces challenges, these banks quickly find themselves in deep water. By concentrating too much in one area, they suffer when property prices decline or borrowers struggle to repay their loans. Let's look at a hypothetical scenario. Imagine a small bank in a town that has provided loans to 50% of the businesses on Main Street. If property values decrease or businesses face difficulties, these loans could turn bad, posing a risk for the bank. This risk is not merely theoretical. It has manifested in past downturns, such as the 2008 crisis and the savings and loan crisis in the 1980s. Smaller banks encounter significant problems due to bad real estate loans during these periods, highlighting a recurring pattern. Small and medium-sized businesses are directly feeling the impact when their local banks struggle. Obtaining loans become more challenging for these businesses, which may need funds for new equipment, hiring staff, or simply keeping the lights on. If the bank tightens its requirements for getting loans, these businesses could find themselves in a tough spot. What we're witnessing is a real-time illustration of this ripple effect. In certain areas, loan approval rates for small businesses have significantly dropped, with recent declines ranging from 10 to 15%. When local businesses face obstacles to growth, there are fewer jobs and less money spent, creating a chain reaction. The bank is struggling to make money, so they can't afford to lend money to businesses. These businesses struggle to grow, and eventually everyone suffers. So, I have more bad news. The stock market isn't doing too well.
I'm not buying stocks. I'm buying pieces of overwhelmingly American business. And I'm happy when that's when I'm doing it. I'm happy when stocks are going down. I'm happier when stocks are going down because I can buy more of them with the same amount of money.
Major players like Tesla have seen their stocks plummet by 13.2% in just 1 month. And they are not alone. Alphabet has dropped by 5%, and Nvidia is also down by 2.8%. While I agree that these aren't massive dips, they do signal bigger problems ahead of us. A lot of this market volatility comes from the recent spikes in interest rates. Historically, even minor increases in rates have disrupted the economy. Now we're witnessing something more profound. Fannie Mae is already predicting an economic downturn in the first half of 2024. So who controls these rate changes? You guessed it, the Federal Reserve. The Fed is back at it. Since March 2022, they've been raising rates from a mere 0.25% to a massive 5.5% through a series of increases. Currently, there's uncertainty about their next move, making everyone in the stock market nervous. In a comparison, Warren Buffett drew comparisons between interest rates and stock prices, describing them as operating similarly to gravity on an apple. Much like gravity's pull on an apple, higher interest rates have the potential to tug stock prices downward. Increased borrowing expenses can hinder spending and investment, crucial drivers for the growth of numerous major companies. As we anticipate 2024, the stock market is likely to persist under this influence, particularly impacting companies that heavily depend on borrowing. In uncertain times, the golden rule of investing is understanding that predicting market downturns is like trying to guess when the next big wave will hit the shore. You might get lucky once or twice, but most of the time, you will be wrong. It simply can't be predicted reliably. The best piece of advice that I always follow is simple. Stick to your long-term financial plan, no matter what the market does in the short term. But if you must make some changes during a market downturn, you can consider shifting some of your assets from stocks to longer-dated bonds, which will reduce your financial risk. For real estate investments, you need to be extra careful. It's easy to fall into the trap of buying so many properties as the bank will approve you for, but make sure you do it for the right reasons. Don't buy just because your neighbor recently bought a house and told you to do the same thing, because what goes up can also come crashing down. If you've already invested, monitor market trends and be prepared to adjust your strategy. Remember, even Warren Buffett continues buying during downturns, viewing them as opportunities rather than threats. Recessions are inevitable, but being too scared to invest is the worst thing you can do for your finances. A few failed bets are better than no bets at all. Taking a page from Buffett's playbook, change your mindset and start to view challenging times as a chance to grow your portfolio. If you want to learn how to take advantage of the 2024 recession to build life-changing wealth, watch the video on your screen.